Hi, my name is Jade, co-founder of Legendary Real Estate Services, and in this video we're going to cover why we're not in a recession yet, even after that banking turmoil that we've been watching unfold over the past couple of weeks. We're also going to cover interest rate volatility, how that affects you as a buyer, but also how it's inadvertently helping you as well. The last thing we're going to cover is just some insights into sellers that you can use to your advantage, what they're thinking in this kind of market that will help you craft and put together a winning offer. So let's dive in. All right, so these are the main four factors that led to the last recession in 2008. I cover this a lot in my videos. One, to contrast how these elements are far from being present in today's economy like they were back in 2008. I also cover, because I update graphs on a monthly basis to show you where we are exactly, what's going on in the real estate market and tracking, so that you know when we're about to hit that recession point and you're well informed and you can prepare yourself for it. The first one is hypersupply. What that means is back in 2008, we had an overabundance of supply in the market as a result of overbuilding, so new construction of single-family homes and residential units, and we had above 6 months of inventory. Anything above 6 months of inventory is what we call a buyer's market. Between 4 and 6 is a balanced market. Below 4 months of inventory, we have a seller's market. As of February of 2023, we have 2 months of inventory. So we're well into technically a seller's market, and we have been since the start, of the pandemic. We are far from hypersupply, and we will continue to be, because housing construction starts and permits have decreased. This national graph nearly corresponds with the Fed's interest rate hikes. So what happens when they raise interest rates, it created volatility. It also became more expensive for builders to build residential units. This is also being reflected in Southeast Wisconsin. According to the Wisconsin Builders Association, Walworth County saw a 3% decrease in housing starts. Racine County, 22%. Kenosha County, 7%. That's why we're not going to see many housing units come online this year. And if the feds continue to raise interest rates and banks tighten as a result of the banking turmoil that I covered in my last video, we likely won't see any relief of new homes anytime this year and probably well into 2024. What does that mean? If you see a well-maintained, competitively priced home on the market, go and see it with your realtor as quickly as possible and make an offer if you love it. And make a strong offer, because you'll likely compete with multiple offers. On the other hand, you also have more power as a buyer than you have in the past 2 years. Thanks to interest rates, that's diminished demand. It's actually creating an artificially balanced market. We don't have a lot of supply, but we also have a reduced amount of demand as compared to 2020 and 2021. So you have a lot more power as a buyer. Going into the recession, we didn't have as much equity as most homeowners do today. So this is a national year-end home sales done by Adam Data of median price homes sold in 2022. And what they found was that the majority of homeowners who sold median price homes in 2022, nationwide, homeowners realized a profit of about $100,000 or 60% return of their initial investment. This is really good news, because when we go into recession, if for whatever reason there is a perhaps 20% drop in home prices, that won't put most homeowners underwater. That'll put them back at maybe pre-pandemic levels. Most homeowners will be able to weather the storm, unlike in 2008 when the average homeowner equity was much lower. Now, the downside to this for buyers is that those sellers, they're the ones you're competing with who have all that equity that once they sell their home, they're bringing cash to the deals. And we're not likely going to see an end to that anytime soon. Not this year, probably not into next year. So continue saving, try to have at least 20% for a down payment, and continue working on your credit score if it's not stellar already. This compares December of 2021 to 2022, the delinquencies and foreclosure rates. As you can see in the bottom right-hand corner, foreclosures are at 0.2, 0.3%. This is an all-time low compared especially to what it was during the past housing crisis. As you can see, between 2008 2010, the percentage of mortgages between 30 to 89 days on a national average, they were about roughly 4%. Again, now we're at all-time lows. And as a result of the banking turmoil, which I covered in another video, if banks tighten lending or reduce the number of risky loans they give out, we're going to see this number drop even more. So that's actually good news. If you're a buyer that's sitting on the sidelines waiting for the bottom to drop out, newsflash, don't hold your breath. That's not going to happen anytime soon. We don't have anywhere near the amount of supply we need in order for that to happen. What could cause the market to drop off? Well, hyperinflation, but the feds are working very hard to prevent that. Something else that could create that is a soul-crushing level of layoffs. Say you have a major manufacturing plant that closes down, that is really the lifeblood of a city. If that closes down, people get laid off, they become delinquent in their mortgages, eventually they go into foreclosure on a massive level. That's going to put downward pressure on prices. Another thing is either a natural or man-made disaster that ruins the livability and viability of a location. And another way for prices to come down is we have an incredible amount of supply. Now that is happening in a lot of major metro areas, Chicago, Austin, parts of California, but we're not seeing that here in Southeast Wisconsin. You're not going to see the bottom drop out of prices in our location. Interest rate volatility. We have seen the fastest interest rate hike that we have seen in almost 30 years, and that has slowed activity for buyers, builders, and investors, and that's good news for you. According to Redfin, investor purchases of homes fell nearly 50% year over year in the fourth quarter of 2023 across 40 of the major US metropolitan areas. You have less competition because interest rates are going up. It's less viable for an investor to make a profit last year and now than it was in 2020 or 2021. And if banking standards tighten and they make less loans, that's going to continue to keep investors out of the purchasing pool. This year, though, we have a couple scenarios. If confidence is restored within the next quarter in the banking system and the feds continue to increase by 0.25% or even less, the market will show signs of stability. If you wait, those investors will come back, probably not in force like they did in 2020 and 2021 when we had ultra low interest rates, but they will come back and get back into the real estate game. That interest rate volatility is actually good for you if you're a buyer, because if you've been grappling with high housing costs and losing out to bidding wars, you're having less competition from investors than when you did in 2020 and 2021. Worst case scenario, if interest rates creep up even higher while lending standards tighten over the next year, you're gonna have some difficult times. Now this graph shows the days on market, and as you can see, we've been oscillating around 30 to 40 days on market. It came down from a bit of a high, but that was over the winter months, which typically happens seasonally. But for the past couple of years, we've been oscillating around 30 to 45 days on market. And it's slowly been creeping up, which has corresponded perfectly with the interest rate hikes from the Fed. We hit a bit of a high, but it was a cold winter, a lot of storms, plus interest rates, and then it came back down. It'll probably stay around 50 to 60 if the market calms down from the bank turmoil, if there's a lot more volatility and uncertainty, and if lending standard tightens while interest rates go up, we might see this go up to about 60, 70, hovering around there. Longer days on market is bad for a seller because it puts downward pressure on prices. In order to sell their home, they're going to have to reduce their price. Longer days on market means that the current pool of buyers don't like the price of a home. So in order to sell their home, they're going to have to reduce their price. The longer it's on market, the more they're going to have to reduce. If you see a home that has been sitting on the market, make a fair market value offer. They'll likely jump on it and they'll likely be open to negotiating rather than face the fear of missing out later or having to reduce their home price even more. They're also going to be more amenable to negotiating and working with you to address any of those structural or value defects or defects that affect the health and safety to occupants. Sales to original list price ratio. This is the big one for sellers. Sellers know that the market is softening or has been softening. The peaks of 2021 and 2020 are gone. This is a seller's worst nightmare. So say hypothetically you are listing your home for $100,000. If you sell it for $105,000, you're going to be above 100% in your sales to original list price ratio. If you have to reduce your price, you're going to be below 100%. This graph depicts one of the biggest fears of sellers, and that's losing money or leaving money on the table. This happens when you have too much time sitting on the market. The more time your home sits on the market, the more likely you're going to have a lower sales to original list price ratio. Houses that aren't priced correctly, that haven't been marketed properly, or aren't in pristine condition with virtually no showings have no choice but to reduce their value in order to get under contract. If you see a home that's been sitting on the market, make a fair market value offer. Don't lowball them because they'll likely reject you, but be amenable to negotiating or cover low ticket repairs. In other words, don't sweat the small stuff. If you come in and you make a hard lowball offer, they're going to probably pass and hope for something better. However, if you make it easy for them, they'll likely accept the win and take your offer. I covered a lot of information. If you have any questions, there's my email. I do these videos monthly. I update them monthly. So go to our site, click contact us, put in your name and email, and we'll send you these videos monthly. We're also on Facebook. I post all of our videos on Facebook, so go there, Legendary Real Estate Services, like our page, and we'll see you on the next video. Thanks. Take care now.